yeah, you summarised a really good set of results for Qube for FY19. We're extremely pleased. I think it continued the half-year results where we forecast that we'd grow earnings per share, where we've continued that through with a 13% increase in EPS on pre-amortisation basis, and obviously on the back of a bit over 15% increase in underlying NPAT for the business. And the way we look at Qube today is pretty much as we call it 3 divisions. We call our operating division, which is the core business that we had at Qube, our logistics business, our ports and bulk business sitting in operations. That had a very good year on the back of some headwinds, as Nathan just mentioned. Probably the strength in the business is really the diversification strategy that Qube has embarked on over the last few years, diversifying by location, and there's a map in the pack of all the locations we now operate in across Australia, New Zealand, and a little bit in Southeast Asia. But diversification by product in that import-export supply chain. And so some of the strengths in the year just finished were obviously forestry products, particularly logs out of New Zealand into China. It's very good strength in project cargoes, the infrastructure project cargoes coming in like windmills and things into our ports. Strong underlying growth in some of the commodities, export commodities. And that strength really helped Qube, as some have said, with a natural hedge of a balance between imports and exports, offset the headwinds that existed, which is pretty well known, the continuation of the drought in southern Queensland and New South Wales affecting our container logistics and our rail operations for bulk grain exports. A reduction in the number of tonnes of iron ore down to 17 million tonnes through Port Hedland, which is essentially on the back of a mine closure, and the slowing new car sales that everyone's well and truly familiar with. So some challenges, some really positives, but a continued growth, and really our outlook is for, barring any world trade issues, Trump and the like, to continue that trend through into FY20. The Patrick business, I think, is the second area of our business that we focus on. That 50% interest in the Patrick Container Terminals business had a very good year, maintained or slightly increased its market share to 46%. It really, I think, is well and truly, we're very happy with where Patrick has got to in this competitive market. Slowing container volumes is certainly a little bit of a concern across the Patrick business, but also that slowing container volumes is partially offset by the introduction of infrastructure charges in the last few years into the Patrick business. And for those that follow it closely, the recent increase in infrastructure charges occurred in March, so we have a full year of that increase that happened in March through into FY20 to hopefully offset some softening in container volumes. Very early to pick that yet because, as most of you know, we can see what Patrick does in a volume sense, but what we don't see is the market until 4 to 6 weeks after the end of the month, when the ports release individual ports release their market data, that you're able to assemble it and have a look at what's happening in the market. Clearly, this next few months, the pre-Christmas, Patrick's business is always stronger in the second half of the calendar year, pre-Christmas, Christmas volumes coming into the country. So it's going to be interesting to really watch what happens in that business in the first 6 months of the next financial year. Patrick's positioned very well with it's started digging the first sod of soil on the automated gantry rail interface at Patrick's here in Port Botany in Sydney. It's well advanced with negotiations on rail interface into the Patrick terminal in Melbourne with the Port of Melbourne, and it's finalising the negotiations on that tender process for extension of the lease in Fremantle. So all pretty good positions to be in from a Patrick point of view. The other area of that market that is still worth watching very closely, and we've seen, as most of you know, shipping line consolidation, shipping lines buying other shipping lines. We're now down to 6 or 7 major players in the world. What's happening in the market now is consortiums that they have been involved in coming to the Australian market are rejigging, and some are coming together. And to give maybe the best example of it, Maersk acquired Hamburg Sud, CMA CGM acquired APL, Costco acquired double OCL, APL, Hamburg Sud, and some of those principals were in different consortiums running to Southeast Asia, North Asia, etc. Those consortiums are re-rationalising, rejigging, some are coming together. And so I think the next 6 months to 12 months is really continued watch on what happens there, and Patrick positioning itself to handle as much of that volume that is in the market at the moment. That volume that is in the market is quite substantial, but it does come from, as you can imagine, when you're rationalising consortiums, some it's already at DP World, some's already at Patrick, some's at the third stevedores. It's just where it lands, and too early to tell on some of that consortium rationalisation that's going through. The final area of business Nathan touched on is Moorebank. Obviously very pleasing with Moorebank. The first warehouse is completed and Target is now operating out of that warehouse, just short of 40,000 square metre warehouse, actually with the biggest solar panels on a warehouse roof in Australia on that roof. We have, as outlined, I won't go through the pack, but clearly we've got 3 other warehouses being built that will be finished by June next year, one for Qube Logistics, one for 2 tenants, and the second one, or the third one, sorry, for a party, half of that for a party that's signed a term sheet but hasn't finalised the agreement for lease on that. And a fair bit of interest, it's fair to say, quite a considerable amount of interest on the remaining warehouses in the master plan on the east side, so on the plan that you see adjacent to the IMEX terminal. No real movement to date. We're still having discussions with the party that entered into the reservation agreement on the western side, the 150,000 square metres of warehousing. That's got a 7-year life from when we first entered into that. They're paying their option fee to hold that land. And then we are on the west side negotiating with a party as well on a substantial parcel of land at Moorebank. So we're extremely comfortable with where Moorebank is at this month. We've run already 1 train in with some containers. We're doing test trains, as we're calling them. We won't be running, a train every day at 7 a.m. and hope the containers get on it. We will be running ad hoc trains as we start this business. We'll run a train that we're running rail today to Yennora or to Minto, and then we assemble a load and we'll run tomorrow into Moorebank, and it'll be ad hoc based on demand for volume for Target and other customers, Qube customers in the area. So it'll be a slow phase take up of rail operations, but very well advanced with that.